In this presentation, we will continue on with part 6 of our example problem related to a not-for-profit hospital. In this presentation, we will be putting together a statement of cash flows. The statement of cash flows will be a timing statement, and in essence will look at things that are happening or the activity or the flows of cash over time. To think about the statement of cash flows, we will be using an indirect method as opposed to a direct method for the operating activities of the statement of cash flows. If you would like more detail on how to put together a statement of cash flows in detail, step by step, it's one of the more complicated types of financial statements that people have problems with putting together in a systematic way. We do have a course on that. You could take a look at that for the more details. Here, we're going to be picking up, you'll recall from the prior presentation, we had the statement of operations and the statement of changes in net assets. This number here, the net increase in assets, is actually on the statement of changes in net assets. That's similar to basically the net income number. In other words, it's kind of like net income on an accrual basis. And now we need to transfer that increase in net assets, basically the net income on an accrual basis, to a cash basis. That's going to be the operating section of the statement of cash flows. So that $90,659, that's where we're going to start in the statement of cash flows. So starting at that point, you'll recall statement of cash flows is going to have three components to it. It's going to have the operating activities, the investing activities, the financing activities. The operating activities are going to be similar to the basically income statement that are now going to be getting to the bottom line of basically like net income or changes to net assets on a cash basis as opposed to an accrual basis. There are two ways that the operating activities can be gotten to. One, using a direct method, in essence taking what would be similar to the income statement and adjusting it to a cash basis line by line, revenue to a cash basis, expenses, and so on, or an indirect method. The indirect method is often actually preferred or required even if the direct method is used, although the direct method makes more sense and is more direct because the indirect method provides a reconciliation type of process between net income, or in this case change in net assets, which would be on an accrual basis, and the cash flows from the operating activities on a cash basis. It shows what the difference is, which it's nice to have that reconciling process. So we will be using the indirect method. We're going to start off with the $90,659 in the change in the net asset and then reverse those types of things that would be removed that were not cash bases to get to the cash flow from operating activities, basically the change in net assets or net income on a cash basis. Adjustments to reconcile change in net assets to net cash provided by operating activities. We're going to start off with the increase in the accounts receivable. So within our trial balance, now this is the adjusted trial balance. These are our beginning numbers, which are the same as the ending numbers for the prior time period. And these are our ending numbers. So oftentimes our worksheet that we'll be using when we put together a statement of cash flows will be the beginning trial balance in essence, or the end of last year's trial balance, which is the beginning of this year, and then the ending trial balance or the balance sheet. So we're going to say the increase in the receivables, once we find the change in all these basically balance sheet accounts, that'll be the types of things that will reverse out for us, because you'll recall that the accounts receivable is an accrual account. It wouldn't be there on a cash basis. So if we reversed out the change in accounts receivable, that will be one of the reconciling items we would need to get back to a cash basis. So to do that, we're going to say that we have the accounts receivable of the 59350 minus the 16700 for the, that's going to give us the 42650. So remember that number. And then if we go to the accounts receivable at the beginning of the year, we're going to say that we had the 44100 minus the 16700, or the 27400. So if I take that balance minus the ending balance of the 42650 we just calculated last time, that's going to give us the 15250. And of course this middle column will in essence give us the change, because that's the net of all the activity that we have recorded to it. So there's going to be the 15250. Note that if there's an increase in the receivable, that means we're going to be decreasing it from the cash flow from operating activities. That's going to be the general rule. You can think through that more if you would like to as why that would be the case, or you could take a look at our course on the statement of cash flows to explain that in more depth, in more detail. Then we have the increase in the interest receivable. The increase in the interest receivable is going to be this item. We had the interest receivable starting at 0, goes up to 1,630. So that means if it's an increase here, it's going to be a decrease on the statement of cash flows. Then there's an increase in inventory. So inventory was at 85,400. It ended at the 90,200. The change, the difference is 4,800. Once again, an increase results in a subtraction in terms of the statement of cash flows if it's an asset. Then there's an increase in the accounts payable. So once the accounts payable is an accrual type of account, so if we reverse it, then we'll be reversing back out to a reconciling item to a cash basis. It started at 20,100, went up by 57,900 to 78,000 during the year. So therefore, there was an increase of the 57,900. Now, liabilities, when liabilities increase, the rule is that we will decrease them on the statement of cash flows. So that's just the general rule. Assets, when they go up, we subtract them. When they go down, we add them. Liabilities, when they go up, we add them. When they go down, we subtract them. If you want to think about why again, you can mull that over. We have a course that will go into more depth on that. Increase in the payroll. So the accrued payroll started at 46,800, went up by 177,790 to the 224,590. That then was an increase. Therefore, we're going to increase the liability here, the change. Then we have the depreciation. Now, the depreciation, you could go down here and find the depreciation that has been recorded. Actually, in our case, you can't find it because we recorded it by function rather than by nature. So you can't find it down here. You could go look at the journal entry and find the depreciation that was recorded as an expense, which would be a credit to depreciation or debit to depreciation expense, or the related account to it, which was the admin, general, nursing, and other, and then credit accumulated depreciation. However, even if you had depreciation expense down there, you may want to do it by the change, and I would recommend doing it by looking at the change in what's happening in the balance sheet accounts, because that's our general rule. That's what we're trying to do here, find all the differences. So we had the beginning accumulated depreciation, started here, ended here, this one as well. The change then being, of course, that 122,500 plus the 134,000, that being the 256,500. Now note, this won't always be the difference. In other words, this will not always equal the depreciation. It will not. If there was a sale or something like that, oftentimes, then and in that case, you would have to go back and deal with that anyway. So that would point out that there would be a further problem that you would have to look into. Here, we had no other items other than depreciation being recorded. Therefore, the change in the accumulated depreciation is the depreciation, which needs to be added back. And the general rule on it being an asset, as we applied up here in the liabilities, doesn't apply as easily to accumulated depreciation because it's a contra asset account. It's an asset with a credit balance. So for that one, I would think that you would think just saying, hey, that amount of net income includes depreciation expense, which decreased the net income. Depreciation expense has nothing to do with cash. Therefore, that decrease is not really valid. We need to add it back in to get to a cash basis. Therefore, depreciation will always be increasing basically the net income amount in the statement of cash flows. And then we have the unrealized loss on the investment. That is going to be the 681 you can see down here. But once again, you might want to think of it up top, and I would suggest you do think of it up top as saying that you had this transaction that resulted in it. In this case, we're just recording the change in the value. So here's the beginning value in the investment. Here's the ending value in the investment. And you can see it went down. So the investment went down, and therefore we have an increase because it's an asset account that went down. We have an increase. We're not going to call it change in the investment as we did with the change in receivable. We're going to call it the unrealized loss on investment. Then if we were to add these up, remember to add all of them. I'll do it in the calculator just to make sure that we're getting all of them. You want to go all the way up to the 90,659. So we got the 90659 minus the 15250 minus the 1630 minus the 4800 plus 57900 plus 17790 plus 256500 plus the 681, and that should be not there. Let's do it one more time. We've got the 90659 minus the 15250 minus the 1630 minus the 4800 plus 57900 plus 177790 plus the 256500 plus the 681, and that should be the 561,850. So there we have that. And then we have the cash flows provided by financing activities, which includes the payment on the mortgage. Note we skipped investing activities because we don't have any. So investing activities, and usually if we purchased equipment or sold equipment, that's a common investing activity. We don't have any, therefore go into the financing activities where we made payments on the mortgage payable. And that's shown here. Here's our beginning balances. And then here's our ending balances. They decreased by the 545. And so that 545 is going to be here. And that's going to give us the net cash provided by financing activities. Then we're going to have the net increase in cash and cash equivalents, which will of course be the cash provided by the operating activities minus the net cash provided by financing activity. And this one should actually be used in, so the language here should be not provided by but used in the financing activities, because this is a decrease. So beware of that. And that's going to give us the net increase in cash and cash equivalents. Then that's going to be the change in the increase in cash and cash equivalents. Notice it represents this change up top in the cash as well as this change. So the net change in the cash is the 8500 plus the 8350 for the 16,850. And then we're going to tie this out to the ending balance because we really want to tie it out to here. To do that, we're going to say the beginning balance, which is going to be the sum of the 379,000 and this item, which is the 18040. That's going to give us the 397.40. And then if we add them up, we get to the ending balance of the 413,890. That, of course, is going to be this number, the 387,500, plus this 26, the 26,390. That gives us the 413,890. That's going to be our ending balance. And that will be the balance that we should be able to tie to the balance sheet. So here's all of our information. This number here, the 413, would be tying to the balance sheet. We could see the balance sheet here and here. So that will be the cash of the 387.5 and the 26,390 would be the 413,890. And of course, the what would be similar to the net income or change in net assets is also going to be tying out to the statement of change in net assets, that being the 90,659.